Energy is pivot in $500 billion Indo-US interim trade agreement. Shifting away oil supply from Russia is key to tariff relief from Trump. Author, K. Ravindran. The joint declaration accompanying the Indo-US trade agreement, where the first item on the expansive $500 billion agenda is energy and the lifting of additional tariffs, is explicitly tied to India curtailing its purchases of Russian crude, crystallizes a shift that had been quietly unfolding in market flows and policy choices for months. But the political sensitivity for New Delhi to accept such a shift is understandable. For decades, India's engagement with Russian crude was the manifestation of its willingness to pursue independent strategic options outside the tight orbit of Western policy prescriptions. During periods of heightened geopolitical tension and elevated oil prices, Russian Urals crude became an anchor of affordability for Indian refiners, particularly private sector players who capitalized on steep discounts relative to other benchmarks. While New Delhi has consistently resisted framing its energy purchases through the prism of alliance politics, the optics and implications of such a reliance have weighed increasingly on policymakers amid sustained pressure from Washington. The India-US joint statement marks a significant inflection point. The conditionality linking tariff benefits to a decrease in Russian crude imports signals that energy has evolved from a technical trade item into a geopolitical lever. Russia's diplomatic rhetoric remains upbeat, with Kremlin officials asserting confidence that the Indian friends will not change their position. Yet, the unfolding trade architecture suggests that Washington is betting on economic inducements to align New Delhi's energy sourcing choices more closely with its own strategic priorities. Assessing the potential impact of this conditionality requires careful disentanglement of market dynamics from political signaling. On the face of it, the notion that India would be forced into an abrupt halt of Russian oil imports carries implications for both New Delhi and global crude arbitrage patterns. But energy markets are currently far more fluid than polarized. The global oil price environment is shaped by a combination of moderated demand growth, structural shifts in supply, and a delicate balancing act among major producers. Under such conditions, India's reduced dependence on Russian barrels is not producing shockwaves comparable to those seen earlier in the decade. Rather than being blindsided by trade conditionality, India's energy sector appears to have already baked in a strategic repositioning. Over recent months, private refiners including Reliance Industries Limited and others have virtually stopped importing Russian Urals crude, pivoting instead towards US grades such as Midland WTI and Mars. This is not mere happenstance nor a reflexive geopolitical gesture, it is rooted in hard economic calculation. The Brent WTI spread widened meaningfully, driven by factors including demand dynamics in China and broader shifts in global inventory patterns, creating an arbitrage window that made certain US grades more cost-effective for refiners operating in Asia. From an economic standpoint, the rise in US crude imports into India makes sense. The cost differential afforded by US grades presented refiners with an opportunity to lock in feedstock that delivered competitive refining margins in the context of contemporary market spreads. These grades offered logistical advantages and pricing terms that, at least for a period, outpaced the discounted economics of Russian crude. That private players, motivated primarily by profit imperatives, chose this path speaks to the decreasing centrality of Russian Urals in the global pricing matrix. The effect on Russia's role as a swing supplier to Asia has been palpable. For years, Urals crude operated with a notable discount to benchmarks like Brent, a factor that helped stabilize flows into markets sensitive to cost pressures. As the Brent-Urals discount has narrowed, however, the incentive for price-conscious refiners to prioritize Urals has diminished. At the same time, risk premia in cargo markets trading into India have climbed, reflecting shifting perceptions about supply reliability, logistical routes and the broader risk environment. Collectively, these factors have eroded some of the economic rationale for large-scale Russian crude imports into India, even before formal policy conditionalities took shape. Viewed through this lens, India's erstwhile role as a stabilizer of Russia-discounted barrels has, in practical terms, moved into reverse. Rather than acting as a safety valve that absorbed excess Russian crude at significant discounts, India is now reallocating its import mix toward barrels that better fit contemporary economic and strategic priorities. This shift has prompted recalibration among global suppliers and traders, who are adjusting their bidding strategies, contract terms and logistical planning in recognition that India's demand profile is evolving. The implications of this evolution are multifaceted. For the United States, India's pivot represents a vindication of long-standing efforts to deepen energy ties with New Delhi as part of a broader strategic partnership. U.S. producers benefit from expanded access to a vast, growing market, reinforcing America's role as a critical supplier in Asia. The tariff conditionality embedded in the India's trade framework underscores Washington's willingness to leverage commercial incentives to further strategic objectives, particularly in sectors, like energy, that are central to national security and economic resilience. For India, the calculus is more nuanced. New Delhi has long embraced a policy of strategic autonomy, asserting the right to make independent choices on matters of defense, trade and energy. The pivot toward U.S. crude imports reflects both market realities and an evolving risk assessment. By diversifying away from a concentrated reliance on any single supplier, India strengthens its energy security and hedges against supply disruptions or geopolitical escalation. At the same time, acquiescing to tariff conditionalities tied to energy sourcing choices raises questions about the limits of India's autonomy in the face of great power competition, particularly when economic incentives are at play. Domestic refining economics further complicate the picture. India's refining sector is finely attuned to feedstock costs, product slate optimization and margin management. U.S. grades such as Midland WTI and Mars, once arbitrage windows opened by specific market conditions, may not always maintain their relative advantage. Should the Brent WTI spread contract or demand in other regions rebound, the calculus for refiners could shift again. India's ability to adapt to such fluctuations will be crucial in shaping its long-term energy import strategy. Russia, for its part, has sought to downplay the significance of India's shift, framing it as temporary and underscoring the depth of long-standing bilateral ties. But the narrative emanating from Moscow must grapple with the fact that India's import patterns have responded to concrete market signals that go beyond mere political posturing. Whether Russia can recalibrate its own pricing structures or find alternative markets to absorb volumes previously destined for India remains an open question that will influence global crude flows in the months ahead.